Hey, everybody. This is going to be a short lecture, I hope, on Chapter 8 in your budgeting textbook. This particular chapter is entitled Taxation Criteria for Evaluating Revenue Options. And I put this, I chose this chapter. I kind of went through the book and so that we didn't have to do all the chapters. And I looked at this one based upon how most of local governments, county governments, and state governments are funded. As we have talked about before, we can't sell our services. Nobody would pay for them unless they needed them, and then it might be a little too late. So taxation, and what I want you to get out of this is just kind of a general idea about the concept of taxation and the process of taxation. There were some really key points that I thought in this chapter that were brought up about taxation that I'm going to point out. But like I say, I hope to make this not quite as long as the last lectures have been, because I do just kind of want you to get that framework about taxing. I love how the author refers to them as coerced payments. We all know that that taxes, what is the old saying? The two things that are for sure are death and taxes. And so he does refer to them as that. He starts off with a quote about how nothing is above our courage except only the courage to tax ourselves. And that's one of the things that our founding fathers said, and we have to recognize that that is how the government is funded. At some point in the chapter, he makes the point that I think about 50% of the federal government, maybe a little more, is based upon income taxation. So there's a couple of questions that he brings out about taxing, and one question is, what is the appropriate level of taxation? How high should taxes be? And we all know that when we think about our own experiences with property taxes, and that's what I'm really referring to right now, and right now with this example, we might live in a neighboring county than the one that we work because the tax base is lower. I have a lot of friends that work at the National Fire Academy, which is in Maryland, but it's about 15 miles from the Pennsylvania state, or 15 miles from Gettysburg. So it's real close to the Pennsylvania line. Well, Pennsylvania has a whole different tax setup. They don't have sales tax. So it may, if we don't have the right level, then we can lose some of our tax base. So that is one question that we have to ask ourselves. And one is a question of structure. How are we going to structure the taxes? The necessary level of taxation can be generated in different combinations of taxes. We have property taxes, income taxes, sales taxes, ad valorem taxes, probably some more that I haven't named. So you have to make sure that he uses a great example of horses under stress. And so we have to make sure that we're not putting too much of a burden. And then the author goes into a brief overview of taxation in the United States, where it says about 55.4% of general revenue comes from taxes, or 70% of own source revenue. And he does explain what that is. He talks about payroll taxes, Social Security taxes, all the different taxes that come out of our check every time we get one. The federal revenue system is really not diversified in that they don't have property taxes. They don't have ad valorem taxes, I don't believe. And they don't have sales tax. So mainly income tax is how they get their money. They do have some taxes on things like, the federal government does have taxes on things like motor fuels, alcoholic beverages, which is probably one I didn't realize. And then, but we don't have any kind of general national sales tax like other nations do. It also collects no property tax. And then the author kind of goes into a discussion about direct and indirect taxes. And indirect taxes are taxes which are shifted, and others that they are taxes which are meant to be shifted. When you think about it, and he makes this pretty plain. I don't know if he does it right here or later, but I never really thought about it. but we think about businesses paying taxes, especially at the federal level. They're paying sales tax, or that's probably not a good example. They're paying taxes. Maybe they're paying property taxes, but all of this is truly shifted to the consumer. So no matter how you look at it, taxes are individual. They're based on the individual is paying those taxes. And so it's not like corporations that are paying all these taxes, they pass it on to us, the little guy, the consumer. This is such a sad topic to be talking about. Trying to think here. Among the industrialized nations of the world, the United States is a low tax country, in the sense of that the federal, state, and local government levels, we don't levy enough taxes because we have we have deficits. We don't levy enough taxes, but I'm so kind of glad. I think that we have to look at it's economics is what it is. It's raising taxes or cutting down on spending. And that's another debate for another day. Some standards on tax policy. You want to make sure that you read that section. It's on page 363 in your book. There is some great points that are brought out there. I'm not going to go into all of those right now. Taxes serve to generate revenue necessary for the provision of government services, and that's what we know. As we said, we can't really charge for most services. And remember, we talked about this earlier in the course about future generations. Are we raising enough taxes? Are we levying enough now so that is it just for today? Or are we looking to the future for future generations so that it doesn't place an undue burden on them? Many times that's not the case. We're thinking about today. Think about your own personal budget. So then there's some, on page 365, he goes into a little math formula that's not too hard to understand, that has to do with tax yield. The tax yield is basically the collections. What are these taxes going to collect? It's the tax rate times the tax base. It's as simple as that. If the effective resident income tax rate is 1%, and the resident income equals 200 million, then the tax yield is $2 million. So that's a pretty easy relationship, except when you turn the page, and this is where he talks about it gets to a point where it's going to fall off because your tax base is going to shrink for whatever reason. People are going to move. People are not going to live there. People are just not going to pay the taxes. I don't know. But you can see the chart that there's an effective tax rate that is kind of that break-even point where if you get much farther than that, you're going to lose your tax base. So that is what is meant by the effective tax rate, is where that, I want to call it a break-even point, but where people are willing to pay and people are not willing to pay. It has to do with, remember we've talked in some of our courses about cost benefit, and I think that that's the same kind of example when we look at this sort of situation. I'm going to move right along in here. You can read this about the national governments. Again, he refers to subnational governments, and we refer to those as state and local. You want to make sure that you don't put all your eggs in one basket. He talks about corporate profits, taxes on corporate profits. Well, when the economy fails, then there goes your profits. So, all right, I'm moving on. He talks about equity, and this is on page 372 in your book. And he talks about horizontal and vertical equity. And so this is how the tax burden is distributed. And there's lots of theories about this. It's something that we hear about everybody wants fair and equitable taxes. But what does that really mean? Bottom line is nobody wants to pay taxes. But we know that that's how, that's why we have jobs, is basically because people pay taxes. So there's two general equity standards. There's one according to taxpayer benefits from or use of the public service, which is the benefits received. And then there's another standard according to the taxpayer's capability to bear the burden, which is the ability to pay. So you have to kind of look at the two different approaches. The benefits received approach, of course, that's very appealing. But also sometimes I think, like, I always think of this in terms of, say, the fire services. Unless I have a fire, I don't need these benefits. But people like myself know that they're there, ready and able to respond, and so that's why I don't mind paying taxes for them. But individuals would pay for a public service if and only when those who benefit, they would pay more than those who benefit less. And so I'm not really sure that that's going to work, I guess, for lack of a better way of putting that. He does talk about people may accept a tax on hunting ammunition if the proceeds are used for wildlife habitat development. So if you target some of this, I know in several states, some of the alcohol taxes go into, I think Alabama's one of them, go into a firefighter pension fund. So yeah, you might accept that a little bit better. There's some problems that do present themselves with the benefits received approach. For one thing, pure public goods provide no divisible exchange in public good transaction. Any purchaser will buy benefits for others. So we're paying, it's kind of the paying into the kitty, I guess, anteing up, for lack of a better term. The ability to pay principle is that appropriability makes public services and private goods fundamentally different, but only the latter are susceptible to market approaches to payment for services, which means this may not be the best approach either. There's two decision elements when we're talking about ability to pay. Selecting an ability to pay measure. What is that? And choosing the way tax payments should vary with that measure. Just this past week, our Vice President of Academic Affairs said that the USG they wanted us to mark courses where we were using no to low cost textbooks or materials. I said, okay. So I emailed her back and I said, define low cost. Well, she couldn't. She had to investigate further, and I guess I was the only one that asked that question. But this is where it kind of fits in. It's like, what? How do you determine what is that? Who has the ability to pay what, and what is that benchmark going to be? And how are we going to make this fair and equitable? Usually, assessment. They may talk about property owners. Well, that's unreliable. There may be other ways to do it. Consumption by households. How do you determine that? So when the author talks about, and I remember the title of this unit is about equity. He talks about horizontal equity, which might also be called equal justice or equal protection. Considers equal treatment of taxpayers who have equal capability to pay the taxes. So if everybody has the same ability, everybody's paying the same. If two taxpayers are equivalent, but one taxpayer pays significantly more tax, the tax structure lacks horizontal equity. So there, our horizontal equity is defined. On the next page over, he talks about vertical equity. It concerns the relationship between the tax burden paid by individuals with the capabilities to pay that tax, and whether it's regressive, progressive, or proportional. And there, your outside reading assignment, there's an article I want you to read that I've posted on the course site about taxes being regressive or progressive. And so that will help define some of what those terms mean for you. A tax structure is regressive if rates are lower in the high ability groups than in the low. Progressive if effective rates are higher in the high ability group than in the low, and proportional if it's the same in all groups. So the little guy if we're talking about regressive, the little guy pays more than the big guy. And it's a rate. It's not an amount of money that we're talking about here, but the rate is higher. And so with regressive, that was regressive. Progressive, the rates are higher. The little guy pays a lower rate. The rich guy pays a higher rate. And then proportional is everybody pays the same rate. So that's what is meant by vertical equity. There's on page 377, he talks about shifting. And this is what I was kind of talking about when I said that, we think about as a consumer, we really pay all the taxes. That corporations and businesses shift some of the tax burden. And you could see forward shifting, the business increases its price to reflect the tax. Backward shifting would mean that the business reduces the price it pays to owners of the resources, including the wages paid to the workers, but the price of the product stays the same. So they just pay less for it. They're going to pay you less. And then absorption, the business may return a lower profit to its owners. It just takes a cut in the profit. So those are some ways that we talk about equity for businesses and the impact that this may have for individuals, that forward shifting, backward shifting, and absorption. Okay, moving on. I'm trying to make sure you read this. I told myself after that last round of lectures that I did that were so long, and I apologize. This again helps us understand the whole process of taxation. So I'm moving on. I'm over to page 382, where it talks about economic effects. Taxes do influence economic behavior. And so, taxes divert money from the economy. I'm thinking as I'm talking that when taxes take money away, like income taxes or property taxes, this is money that we don't have to put into the economy. But maybe it's that indirect method whereby a government puts the money into the economy when we pay that. So taxes can have effects on economic activity, and tax incentives, good and bad, are part of that policy. So when we talk about some of the different choices that people make, the difference between before and after tax prices, payments, rates of return, work versus leisure. If you have high taxes on extra income earned, and we've seen this, we used to talk about it at the fire department, when you work an overtime shift, and then you work another overtime shift, and you work another overtime shift within the same pay period. Who gets that money? You don't get that much money. You may, but most people, Uncle Sam, it increases your tax obligation. And so a lot of times the government gets more of that money. And what this is saying is that there will be a break even, again, that break even point where the scales get tipped between, I'm really not making that much by working this overtime shift. I could be resting, relaxing, spending time with my family, doing whatever I want to do. So be on vacation. So that is one of the things that we have to look at. Business operations, estate property tax inventory that's held on a particular date can induce the firm to ship inventory out of state. or, you know, we know that they have these pre-inventory sales, I think particularly of car dealerships. It's kind of interesting. The author uses an example of how the high cigarette tax in New York City, combined with a price of combining to $5.85 per pack. Now, I don't know if that was the pack without the taxes or if you were combining it with that. It led to the establishment of roll your own cigarette shops, where the tobacco is made available. You come in, you roll your own. This is tobacco. And because there was a much lower tax on loose tobacco. So there's that part of it as well. Shopping purchases and business location. Many times when we go to make those big purchases, we'll go to a state that doesn't have sales tax, or that doesn't have a sales tax on a particular item. I think it's kind of like I was talking about Maryland versus Pennsylvania. You know, you're going to go to Maryland. Going to go to Pennsylvania to make purchases and in these business locations. Personal management of the money, because travel expense to professional conventions, you can take that off of your taxes. So conventions are held in resort locations, and that way you kind of combine those two things. You have a little vacation while at your convention. Productive investment and financial portfolios, of course, these are expected to be influenced by the after-tax rate of return as well. And then savings. You know, when you don't have as much money, savings can distort the decision. Taxes can distort the decision to save. You know, if I have to pay, now this was back when we were making a lot of money on interest, which hasn't been the case in a long time, but, you know, it was like, why do I really want to save if I have to pay all these taxes? It may make, you may postpone some of these things by spending the money now. So those are some things that can happen when we talk about taxes. And the author refers to this as tax avoidance. And it's different than tax evasion. So all of these things that we just discussed are legal. Nothing wrong with that. There's nothing wrong with having your conference at a resort. But tax evasion, on the other hand, yeah, that's pretty much illegal. It involves actions by the taxpayer to reduce taxes by illegal means. Don't do that. It's failing to report income, overstating the amount of deductible expenditures, misusing a sales tax exemption, and so on. So tax avoidance is okay. Tax evasion, not okay. Let's see. Collectability, he talks about. I am going to let you read that part on your own. I'm moving on how we do that. One of the things he does talk about that I think is key is transparency. And this is where we get, you know, that's one of the things that we run into with government as a whole, is that transparency, which is shining daylight on the operations of the tax system, is critical for good governance. And he makes a statement here. We've all heard of, you know, taxation without representation as a part of our history. And he says taxation without comprehension is as bad to democracy as taxation without representation. So politicians are not real keen on this. They don't like to admit how taxes are being handled, or that taxes might need to be increased. You know, that's not going to get them reelected. And especially that taxes, you know, if they're going to try to hide taxes from an incoming business or something like that. So tax transparency has several aspects. Adoption of the tax laws. These should be adopted in open legislative session, no secrets. Administration of taxes should be based on objective and explicit criteria that are apparent to all and should appear to be reasonable to all. One of my things is you kind of have to sift through a lot of fluff to get to the definitions that we're looking at and to get to this process, but it is there and it should be available to all. And we should know the process for appeal. We should know what standards are going to be used if we do appeal. Tax calculation should not be a mystery. Every taxpayer should understand how the tax he or she is paying is determined. I think I do most of the time, but not sure. The amount of the tax burden, this should not be hidden either. This has got to be transparent. Each taxpayer should know how much tax he or she is paying and should know to what government the payment's being made. Hidden taxes are not likely to allow sound choices. So we want to make sure that we know who we're paying it to and what we're paying and why we're paying it. We should be able to ask all those questions. A tax structure that's not apparent is probably unfair. That is not transparent, excuse me. Is probably unfair, can hide inequities, and could be subjected to rigging in some way. So transparency is huge when we talk about taxes. And then I think the last little section that I want to touch on here is about state and local taxes and economic development. This is where it really kind of gets down to us and our bigger concerns. State and local governments are interested in the impact that their taxes have on economic development and particularly on jobs. We want industries to come. We want big businesses. There's Amazon is one that I can think about coming to Georgia. And there's some news story out right now. I haven't read the story yet about if it comes, look out. But that's another story for another day. State and local governments want to manipulate their systems to influence locations of businesses, employment, and even physical investment. And then he asked the question, do taxes really have much impact on growth and development? And his answer is a little bit long. First, tax levels may have a small effect on interregional location of activity. Now, like whether a business locates to North Georgia or South Georgia, that may be a small effect. But if they look at another state, that might have a difference within a region. You know, if, as he says, if the location choice is between Louisville and Cincinnati, there's not going to be as much difference as there would be between Louisville and Phoenix, Arizona, who I don't think pay they don't pay income taxes. Maybe one of those taxes they don't pay. So within a region, the taxes may be similar, but outside of that region, they may not. But you know, it depends on how much the business is willing to move and what sort of concessions can be made with the governments. I know a lot of times when businesses are looking to come in, and cities and municipalities that have their own utility services, they'll cut them a deal on those rates. So that is something that we want to think about as far as our local and state taxes and how it can affect us. Taxes and externalities, emissions taxes, indirect taxes on goods and services. Like where I am, I don't have an emissions tax. I guess I don't. I probably do, but I just don't know it. This is where you have to go have your vehicle inspected. I don't have that. But there may be something called green taxes. You may have an emission tax on fuel. You may have a green tax on high motor fuel taxes. So there's other ways that we can tax other than income, other than property. But we have to understand that this is how we get our money in the government. And like I say, I just briefly ran that through, even though I talked for 30 minutes. There's a lot of information in that chapter. I think we just need to gather a concept of good and bad taxing, about good and bad practices in taxing. But as far as administrators, we don't set a tax rate, but we have to work within the parameters. Our budgets have to be within the parameters of that tax rate. So understanding taxation is a very important concept, especially at the national level and then at the state and local level, because that is how most of our money is received. So this is my quick little, not so quick, lecture on Chapter 8. I'm going to try to do a PowerPoint for the next chapter coming up. And you do have the article to read on progressive and regressive taxes and do an article review on that. Thanks so much for your attention. I hope you guys have a great day.